Hello and welcome to the Weekend Investing Daily Byte of 26th of December. Hope you had a great Christmas yesterday. And the market, as expected, is very dull in this last week of the year. Today, we are going to discuss the role of FIIs and how they may force the government to rethink what they may be doing. We'll go into the past and see what kind of pulls and pressures government and FIIs have exchanged, and how it has resulted in maybe sometimes government pushing back what they were trying to do. Of course, always read the disclaimer fully. This is in your best interest. And do subscribe to the channel if you haven't so far. This is also in your best interest. Where is the market headed? So, absolutely flat, three sessions of nothingness. You can see the closing of all three sessions. The last three sessions have been virtually identical, and all three are within the large candle that was made last Friday. So we are not out of the woods yet. We must break up above this candle high to get some confidence on the index. Otherwise, this is just a consolidation that is happening, and in continuation, it may just sink. That is the expected outcome right now. Anything going above this day's high, closing this gap, going above the average, then it may start to look better. But as of now, that possibility remains remote. Nifty for the day 0.1% up. Nifty Junior slightly better, 0.45%. But again, this 3 days session has not even able to take 40% recovery from this fall, from just one day of fall. I'm not even talking about the previous week. So this 3 day session is virtually not able to climb back up at all. Um, and this is despite FII selling not being big at this point of time. Mid caps clinging on to the 40 moving average, 40 days moving average. The good thing about mid cap chart, if one were to look for good things here, is that all 3 days recovery has come from the bottom. You can see long legs on these candles, and long legs signify that bulls were able to pull the market back up before close. However, none of these days were green, and they are sitting at the bottom of this long candle, which is not looking so nice. 0.08% for the mid caps, and small caps also absolutely flat at minus 0.03, almost as if market has gone into a coma and is preparing for New Year's celebrations. So nothing really to report from the market perspective. Bank Nifty also 0.12%. Lot of intraday volatility, going up, coming down, doing so. Good fun for brokers, accumulating brokerage. Pathetic outcome for intraday traders, I suppose, and nothing for slightly longer term investors. The momentum investing, the momentum trends that are forming in terms of advanced decline, 209 versus 283. So again, slightly biased towards the declines, but not as much. And anyways, these flattish markets, one really can't make out much from these days. Adani stocks came back up along with Mahindra and Mahindra, Maruti, Bharti Airtel, SBI Life, other insurance companies, Bajaj Auto, Tata Motors, Ultrasemco. Some of these stocks were up. Reliance was slightly down along with Titan. No major moves in any of the stocks in any big way. Banking stocks, HDFC Bank down a bit, ICICI Bank absolutely flat, State Bank of India absolutely flat. Nothing much to report here. In the Nifty Next 50 space, you still had a lot of green. So you had PFC recovering, REC recovering, Adani stocks, as I mentioned, three stocks recovering, Indigo going up, Divi's Lab going up, DMart going up, and some stocks like Zomato, BBL, JSW Energy, IRW, IRFC, Bosch, Zydus Life, all these coming off a bit, others completely muted and flat. Siemens and ABB that have been falling also have stabilized now. Sectoral trends, autos for a change, last 2 days have led the pack, 0.8%. This week, autos are down only 0.8% now. This month now down only 0.2, 0.3%. So auto numbers are expected on 1st January. December usually is a decent month for autos. A lot of inventory for 2024 is getting is likely to get cleared. A lot of discounts are there at the year end to get rid of this year of manufacturing inventory, and that probably can help boost some sales. Pharma doing quite well, 0.7%. Public sector enterprise, some recovery at 0.5%. But other than that, there was really nothing to talk about. Plus or minus 0.3% is where the rest of the market is. In the last 1 week, only pharma has sort of managed a green outcome at 0.1% and FMCG at 0.2%. Virtually nothing to talk about. But IT and real estate have lost 2.9% and 2.4% in the last uh, 1 week. In terms of autos, you can see it's trying to turn around from here. It is doing better than the leading index in the sense that it is trying to recover from this long candle on Friday. Some gains on some stocks, but nothing really, I mean, very strong on there. Stock spotlight is on Intellect Design, up another 14.9%. So it is coming closer and closer to its previous highs, and this is looking good in dull markets whenever stocks are going up. So let's come to the topic of the day. Will FIs force the government to rethink what they've been doing? So recently, as you may have seen, that there was a lot of chatter about P notes and how the KYC norms have to be tightened, and there was some scare in the market also. And this is not the first time it has happened. I mean, in the past also, a lot of regulatory troubles have been forced into the market on FII's back, you may say. So the FII trouble is brewing right now, as you very well know. Um, and ET says whenever FIIs sell in India, they have the power to bring down the markets by 0.27 times. FIIs have consistently sold. I mean, give besides a few days of green in the last 2 months, you can see they have been consistent sellers, and of course, DIIs have been consistent buyers, uh, contra to the FIIs. And if we look at the past, so in the past also in 2012, the then Finance Minister Pranab Mukherjee presented the Union Budget, and he introduced the retrospective taxation on FIIs, and immediately, it rattled FIIs, and a lot of selling came through because the India tax environment was seen to be not stable and not conducive. And within 2 months of that announcement, Nifty fell by nearly 10%, led by heavy selling from FIIs. The rupee also went for a big crack at that point of time. So back then, when the backlash came, the stock sold, the rupee weakened. The government then postponed that implementation of the new policies and eventually diluted most of these proposed changes. Uh, so, so despite this, FIs warned that they would sell Indian shares en masse if changes were not reversed. So they do have a clout in terms of, a uh, a grouping in the market which has, I think, somewhere close to 16% of India's market cap is held by FIIs, and hence they are a powerhouse in terms of influencing policy making regarding markets and taxation and so on and so forth. Although the government doesn't seem to be listening to anybody, but they do have the power to make the government rethink about any such adventurism that the government does. So do we have a similar situation now is the question. Indian equity has been hammered now for the almost for the past year, and yeah, renewed FII pressure has been there. Domestic participation, of course, has tried to ebb the fall. If it was not for the SIP inflows going up from 8,000 crores to 25,000 crores, it would not have sustained at these levels. We would have probably been at, maybe, I don't know, 16,000, 18,000 Nifty. So aggressive selling has happened, 1.8 lakh crores just in October and November, and 22,000 crores more in December so far. So FIIs are, giving some signal to the government that, we are not going to stay, or we are selling out because of this, continuous tinkering of taxation, continuous tinkering in the economy, narrow sort of mindedness in terms of how to grow the economy. There is, and in my personal view, I could be totally wrong. I think the promise that the current government had with investors, whether domestic and foreigners, seems to be going downhill very, very fast. So people are now extremely skeptical whether the same growth mindset is there in this government now. have their agenda totally moved towards squeezing retail as well as all kinds of investors in the market? I remember small things like securities transaction tax. When it was introduced as a measure to track, who is doing selling in the markets, and hence capital gains can be calculated. Then once that was in place, it became a tool to extract tax from from the market itself. And there are many such examples where GST was supposed to be one tax for the nation. Then they said, okay, some people cannot pay that much tax, so we'll set aside some basic uh, things that will remain free of GST. That is also fine. Then they said, okay, we'll have another slab because everything cannot fit into one slab. Then they said we'll have four slabs. And now you have seen recently what kind of joke is happening in terms of where is the focus of our tax policy going. So extremely disheartening to see that we have lost complete focus on the core, focus that should have been, and we are now just tinkering around with every budget. There's a lot of hope, and then you'll find that uh, something has just changed by some small amount here or there. So that is not bringing consumption back into the market. People are fed up of not having enough disposable income in their hands. Inflation is rapid. The suggested inflation numbers, I don't know how, because they say inflation is different for everybody depending upon what you're consuming. From most people I talk to, I mean, the 4 5%, 6% inflation number doesn't go very well with them, because things are rapidly expanding. So there's a lot of dissatisfaction that is building in with investors and other places. Of course, the domestic flow of money has completely overshadowed this sentiment so far, and that's a good news that at least something right is happening there. Now, there's there are other things that are happening which are causing a lot of these FII outflows, and one of them is also FII outflows from our bond markets. I mean, we were supposed to have a thriving bond market by now, and that was one of the planks earlier introduced by this government. But so far, I mean, we are not there, and the spreads between our yields and US yields have narrowed so much that they've just been coming down. So now only 225 basis points is the spread between India and US. So if spreads are so low, why would an international investor come to India to invest in India bonds, for instance? They would rather invest in US bonds and only have a 2.25% differential. If when they come to India, invest in India, they also have to suffer maybe a 2 to 4% depreciation on the currency. So what is the whole fun for anybody to come in here? So you need to change with with the dynamics with the changing market. We are reading that RBI has held back the US dollar INR by spending $65 billion. I mean, had we sort of flowed with a rest of emerging markets, potentially we may not be in a situation right now where which is causing us to be very very uncompetitive, and we are having to raise all kind of tariffs around us to have a good export outcome. And as a result of that, countries like US, etc., are threatening us now on tariffs. So I don't know where this is going in those terms. I mean, it doesn't seem like a very smooth future for the current thought process. So, I mean, while there are many details on bonds and so on and so forth, how this is impacting, I'll not go into too much detail on this. But depreciating rupee, you can see here, for a long period of time, RBI has held back on letting the rupee go, and only very recently, once China has started to depreciate very very rapidly, has the Indian rupee gone from 83.9 to 85. Not too much actually. Also, there is slow growth now. I mean, US is growing at 3.1%. We are growing at 5.4%. Not such a huge difference if you tell me in terms of a mature market versus an emerging market. And GDP projections are all coming down. Inflation is going up in India. Investor sentiment seems to be dropping, and there is more and more money that is going towards the US. More and more opportunity seems to be happening there. Taxation has been tinkered around. I'll not get into more details on this. You very well know this. How everybody is feeling very squeezed on taxation, and whenever it's a uh, aggressive tax regime in any country, there will not be any inflow of capital, or even the domestic, the up to certain point, the flows will come. Beyond that, tax is going to eat everything. So this is something that is very, very concerning. A recent meet of economists for pre-budget meet with the government, everybody has unanimously said that you must reduce taxes because people are not left with consumption in hand. And let's see what the finance minister will do with that feedback, because if they go on the budget day and not do any cuts, it would certainly mean that all this advisory and consultation and is just sort of just doing a process and not really going through it anyhow. So investors, as I said, rushing into US equities, you can see the kind of money that has flown into the US equity funds, and all because the right narrative, the right at least intent is being shown by people who have not yet even come into the office. And that is what is causing a positive sentiment to happen. We can always, even if we are not doing too much, at least have a positive sentiment to talk about. All we hear on TV is popcorn this and popcorn that, and that is really, really very silly. So the US is pulling in funds. It is pulling in funds from all over the world, of course, but India should have been that place from where at least that pull would not happen because of obvious growth potential that our country has. And this is sort of my rant on the current state. I know a lot of you may not agree, but that's okay. What do you think will happen going forward is something that I would like to see in the comments. Do comment in the for with your views, and we'll interact there. Thank you so much for watching, and do like or share this video if you did, and do subscribe to the channel to motivate my team. Thank you so much. Bye bye.